all day, every day for 25 years. I look at motor carriage risks, decide which ones to accept for the insurance company, and we do this for several companies, about 5 right now, which ones to accept, which ones not to accept. And if we decide to accept them, how are we going to price them? Okay. Yeah. So when an underwriter looks at a commercial auto risk, there's a whole lot of variables we look at, a whole lot of things go into the whole selection and pricing processes. But the top 3, the 3 things that we spend most of our evaluation time in, the 3 things that most of our evaluation weights go to, the 3 things that will most impact your premiums and acceptability are drivers, losses, and safety compliance. So we can take a look at each one. With drivers, we find about 89% of crash events, the driver is assigned a critical reason for that crash. Okay? And it may be the driver of the commercial motor vehicle. It may be the driver of the private passenger vehicle that the collision occurred with. But in about 89% of motor vehicle crashes, the primary cause was either the driver's actions or lack of actions in that crash event. Okay? The other 11% are things non-driver related, weather, hailstorms, tornadoes, things like that, and vehicle issues, drop the drive axle, something like that that was entirely due to a vehicle. But about 89% of it come from drivers. So inevitably, the insurance industry puts a whole lot of underwriting emphasis on the drivers. Top things we look at: driver age. There's plenty of industry data and statistics to tell us that a disproportionate amount of claims come from drivers under the age of 25 or over the age of 65. So underwriting analysis will favor accounts where all or the majority of the drivers are within a preferred age band, something like 26 to 65. Okay. We may accept drivers outside of those bands, but they likely have an impact on the pricing. Okay. On small accounts, if it's less than 10 power units, the typical approach in my industry is each driver is assigned a premium surcharge or a premium discount. Okay. We do that in several factors. Driver age just being one of them. But we go through each of those factors, and in each factor, the driver has a surcharge or a discount. We average all those together, and that driver may have something like a 1.08. That means there's going to be an 8% premium surcharge for that driver. We add all the drivers together and then find the average for the account. Maybe the average becomes a 1.02, 2% surcharge, or a premium discount, for very strong driver pools. So that's generally how it's done. In larger accounts, I work in the fleet space. My world is, truck fleets, 15 to 50 power units typically is, what I underwrite. But in the fleet space, we just look at percentages. What percentage of the driver pool is within our preferred age band. And the better that percentage, the better the pricing tends to be. We have premium deviations based on where that percentage falls. So that's driver's age. The next thing we look at is driver's experience. We pull, my whole industry is driven by statistics. I can slice and dice information any way I want. I can tell you how flatbed carriers perform from a loss perspective versus dry van carriers. I can slice and dice my information to determine how dump accounts hauling coal compare loss-wise to dump accounts hauling sand and gravel. We can tell you how 25-year-old drivers compare to 26-year-old drivers. And we can tell you how experience impacts premium. And we find driver with 2 years experience is probably acceptable to most insurance companies. Different insurance companies, different criterias. 2 years tends to be a minimum with a lot of the preferred carriers, but drivers with 2 years CDL experience do not perform as well for us from a loss standpoint than do drivers with 3 years CDL experience. And drivers with 3 years CDL experience perform better than 2, but not as good as 4. And 4 is better than 3, but not as good as 5. Somewhere after about 5 years CDL experience, it levels off. It probably makes little difference at that point. But the industry absolutely looks at the amount of CDL experience for the drivers and uses that again as a price deviation factor. Same thing as we talked about with driver age. If it's a small account, we're using an individual factor for each driver, creating an average at the end. If it's a large account, we're just looking at percentages. What percentage of the driver pool has 5 or more years CDL experience? Here's just an industry study, but you can see here this is just an industry study contrasting years experience with crash rates. As years experience increases, the probability of the driver being assigned a critical reason for the crash event diminishes. And for drivers with less than 5 years of experience driving a truck, the odds of the driver being assigned as the critical reason for the crash event is about 41% higher than it is for drivers with more than 5 years experience. So just one of several studies that do this. The next thing we look at with drivers is accident and violation history. For insurance carriers, we usually look back 3 years or 36 months of MVR history. Okay, certain what we call major violations, like a reckless driving, leaving the scene of an accident, DUI, speed more than 20 miles over limit, those kind of violations, the look back period may be 5 years. Okay, all this varies a little bit among insurers, but all has a whole lot of consistency. It's all very close. But there's industry studies show that certain violations, certain past behaviors are predictive of future crash risk. So driver accident and violation history becomes a large part of the underwriting cycle for insurers. Again, small accounts, we're doing that deviation individually, averaging it together. Larger accounts, it tends to be what percentage of the drivers are accident and violation free. If it's less than 70%, it's going to be problematic for most of the preferred insurance companies. You want to see at least 70% of the MVRs clear. What percentage of the drivers have no at-fault accidents? What percentage of the drivers just have one incident or less, that incident being a minor violation or an accident. Here's back to an Actuary study. Again, this is one that Actuary's done every 4 years, and it's always anxiously awaited by the insurance industry. These statistics change a little bit each time, but the usual suspects tend to be the same. Okay, this is a driver with a reckless driving violation is about 114% more likely to be involved in an accident than a driver without a reckless driving violation. Okay, that's in the top 3 every time Actuary does this study. A failure to yield right away, a driver with that violation is about 101% more likely to have an accident than a driver without that violation. A driver with a past crash is about 74% more likely to have another crash than a driver who hasn't. So, information like this is exactly why insurance companies make all the deviations and why they spend so much time analyzing drivers in the underwriting process. But the next major thing we look at with drivers is driver turnover rate. Okay, as we slice and dice our data, we find that about 70% of accidents come from drivers in their first year of employment. And it makes a little sense if we stop back and think about it. A driver who drives the same routes every day knows where the merge points are, knows where the hidden intersections are, knows where the steeply banked exit ramps may be. Okay, and a driver who's been employed a long period of time understands his employer's expectations, may be more comfortable shutting down in adverse weather conditions than a driver who's newly employed and is a little afraid to take that responsibility upon himself. A driver who's been employed a long period of time understands the expectation of the shippers, understands the safe handling and securement procedures for the commodity being hauled. So we find that drivers employed more than a year, more than 2 years, are much better loss potentials for us than a driver who's learning all those things for the first time. So underwriting analysis, again, looks at driver turnover rates, okay, and deviates pricing depending on those driver turnover rates. Usually we're looking at what percentage of drivers have been employed less than 12 months, what percentage of drivers have been employed less than 24 months. The smaller those percentages, the more favorable the pricing tends to be. So, it's absolutely true. The drivers you hire and the drivers you retain will influence your insurance rates. They may make it better, get you into preferred insurance carrier territory where the pricing tends to be really aggressive and competitive, or they may make it more challenging, okay, putting you into a different class of insurers who play with higher premiums, and things. So, some strategies to consider to address this. One, develop written driver hiring guidelines and hire within those guidelines. Life's a balance. You have to decide the minimum age of a driver who may be acceptable to you and how that minimum age of a driver may impact your insurance rates. So, best industry practice, develop written guidelines, put them in writing, and hire according to those guidelines. Minimum age you'll accept, minimum amount of prior CDL experience you may accept. What's your tolerance for accidents and violations in the last 3 years for a driver you're going to hire? What violations are simply not acceptable to you? Okay. And then the same thing has to hold true for the drivers already in employment. We have to look at them periodically. I think once a year, right, Jared? You have to run an MVR for a driver in your employment. So what are your tolerances for those drivers? When they develop accidents and violations above a certain threshold, they're impacting your insurance rates, they're impacting your business. So, written guidelines for how we deal with those drivers, driver periodic performance reviews, important best practice, and a process to counsel, train, coach drivers whose driving record starts to approach your concern thresholds or starts to exceed those thresholds. And then certainly communication, what you do with your safety meetings, communicate to your drivers. The more they understand how their actions and MVRs impact your business, that's just part of the culture of the company, making the drivers understand that has an impact. And then driver retention strategies. It's been a while since I've seen this number. I think it was I don't think I remember who it was. But the last time I saw a number, it was about $12,000 industry-wide to recruit and train a new driver. So there's a stake in this for everybody. Insurance companies find more losses. You have a lot of expenses. You usually have lost time with the new driver. He has to be trained. He's not as efficient as the driver who left. So driver retention is good for everybody. And we know the turnover rates are horrific in this industry, but strategies to help retain your drivers are good for everybody. One of them is just know who you hire. I think John talked about the necessity to make those prior employment phone calls. Look at the application, interviews, find out why the driver's changing jobs. Job hoppers tend to be job hoppers. If a guy has 5 employers in the last 3 years, you probably become number 6 in 3.5. So be careful or know who you hire. Things that help drivers stay driver incentive programs where you have a bonus for past DOT inspections. You have a bonus program for driving accident and violation free for the year, bonus program for fuel usage. Those are good incentive programs for drivers, help them be happier being employed by you and stay in your employment. And the number one reason that's usually cited by drivers for leaving their employment is not pay. It's always quality time at home. Trucking competes with construction all the time for talent. And a lot of drivers end up in the construction industry because they clock out at 5 o'clock, they're home with their families. So it's always been one of the challenges in keeping drivers in employment in trucking. But the more you can get your drivers home and give them quality time at home, the more likely they are to stay. Again, it's the number one reason drivers cite for leaving their employer. So, just working routes or whatever, you understand your load commitments and everything much better than anybody else does. But, find ways to get your drivers home on a routine and repetitive basis. Quality equipment helps. When I started doing this years ago, we were still using cab over tractors. I think they're largely gone, but lots of drivers, cited dissatisfaction with cab overs. And there was some migration of drivers from accounts that had cab over tractors to accounts that used traditional tractors. So I think, that's a possibility. Quality equipment, competitive pay and benefits certainly, is important. And the last is just exit interviews. If drivers are leaving, take a moment and talk to them, find out why they're leaving your employment, what looks more attractive with the other company they're gone to, and then we can find some strategies or some ways to address those concerns and hopefully not have that issue again. So that's drivers.
If you found this video useful, hit the like button and subscribe to our channel for more future videos that'll be coming out.